I was about to have a $60,000 tax bill come due. And by doing this method and by doing this model that it was suggested, it's basically able to wipe all of that tax liability away, other than I think about $700. So I can say I'm pretty pleased with this process, and it has gone extremely smoothly and extremely well.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset.
Quick disclaimer that I am not a CPA, attorney, or financial advisor. My thoughts and opinions expressed in this podcast are provided for education and informational purposes only. My views are from being a successful business owner, entrepreneur, and real estate professional for over 20 years.
I'm glad you're here. Now let's dig in.
Hello, listeners, and welcome to the Freedom Point Real Estate Podcast. Thanks for joining us today. My name is Drew McWilliams, and I will be your host. Today, my guest is Mike Armstrong. Mike lives in Wisconsin with his family, and today we are going to be learning about accelerated depreciation on real estate via a method called cost segregation and why that's so beneficial to investors. Mike, welcome to the show.
Hey, thanks, Drew. Thanks for having me.
Yeah.
As Drew said, I work in a specialty tax niche called cost segregation. I work for a national advisory and accounting firm called Aprio. So we're all over the country. We do a lot of things for our clients. We like to think of ourselves as advisors first and accountants second, but we do a traditional accounting also. As Drew said, I live up in Wisconsin. We have people all over the country. Most of our offices are in the Southeast, but again, we have some offices in the Northeast and the West, and we're always looking to expand. And as we grow our company, we have brought in people that, always aren't in the right markets where our offices are, like me. So we work remotely. We do go in the office once in a while. I travel all over the country seeing buildings. So that's, kind of where I'm at.
Outstanding. And just to give our listeners, Mike, some background, some color of our connection, myself and the company that my wife and I have owned for the last 17 years, we have been Aprio clients for about 15 years now. And we've been very pleased with all of the accounting and CPA work that they have done for us. And just recently, Mike has crossed our path as an expert in doing this analysis and being able to do this cost savings. And I personally am in the middle of this process with Mike doing this cost segregation and accelerated depreciation on one of my commercial buildings that I own. And Mike had the great ability to fly to Charlotte, North Carolina last week. We were able to meet in person. So we're going to be giving you a little bit of color, and I'm going to be sharing my example of exactly the results that this process was able to do for me. So just kind of give us a little bit more of your background of, how did you get into this industry?
Right. So, there's not a degree in cost segregation. When people get into this, I've never known anyone who went to college and said, I'm going to be in cost segregation. So most of the people in our industry, they're engineers, or they come from accounting backgrounds. Like I was at a Big Four firm. I did fixed asset work for the Big Four firm. Or they had a cost segregation group who did cost segregations for our firm. So I got to know those guys, and I eventually went into their practice. So that's kind of how a lot of people start. There's also like construction management people. But the process is engineering based. So we're looking at the buildings specifically and, different parts of the building. And just, to kind of get into the process of cost segregation, when you think about a building, there's the plumbing system and the electrical system and the exterior and the interior and the finishes. To a normal person, that's just part of the building. But when you look at it for tax purposes, those things are treated differently for taxes. And when we talk about accelerated depreciation, what we're doing is it's a timing difference. So we're going to take more depreciation in the front end of the property that you're depreciating and less on the back end. And what that does, it gives you more deductions in the front, which gives you more cash flow. But on the other side of that is you're giving up some deductions in later years of the property. And the IRS acquiesced to this system in a court case. It's a very important court case in our world. It's hospital court, but before this happened in 1994, they were basically saying you cannot break up parts of the building, and they would just fight you all the time, saying it's all one unit of property. It should be treated as 39-year property, and everything else doesn't matter, basically. So in hospital corp, they acquiesced to this, saying, okay, this is a strategy that you can use to peel off parts of the building. And what we're talking about peeling off or reclassifying into shorter life, we're talking about things that are used for the business for the most part that aren't part of the building. So if you things like computer connections and millwork in the break room and plumbing in the break room and the types of flooring that can be removed easily, like carpeting, or, today everybody's got plank vinyl flooring. That's considered 5-year property. Custom millwork for the most part is, not part of the building. So all of these things can be treated as personal property. And based on the type of business that you are, it's going to be 5 or 7-year property, so that you depreciate over 5 or 7 years versus 39 years for a commercial building or 27 and a half for a residential rental building. And also a big portion of what you can reclassify is the things outside of the building, the site improvements. So parking lots and sidewalks and landscaping and site lighting, those types of things are considered land improvements, which also are not part of the building. Those can be depreciated over 15 years instead of, again, 39 or 27 and a half.
Mike, that's great background and kind of understanding. So, and just to give our listeners that might not have ever heard of this approach before, just to kind of give an overview, just kind of what you said, commercial real estate versus residential real estate has a depreciation schedule across it. Now, just to unpack what you said, those are different years and different terms based on residential versus commercial. Residential, 27 and a half years, equally how you depreciate that, correct? 27 and a half years.
That's cost, correct.
Okay, equally. And then for commercial space, longer time period, 39 years. And that depreciation, again, is equal over 39 years, unless somebody does this method and moves all of that depreciation up in the first several years. So you're basically front loading the depreciation over 39 years up front to get that benefit sooner, correct?
Correct.
Okay. And certain line items, as you were mentioning, from electrical to plumbing to flooring, those all have different life cycles. So you're able to accelerate certain specific items sooner or more aggressively, it sounds like, than other. Is that accurate?
Yeah, I don't know if I'd use the term aggressive, but I mean, that's just how they're depreciated. I did want to mention one thing. When you do this, typically you would do this when you place the building in service in the first year. But if you don't, you can always go back and do it. You can do what's called a look back study, and you don't have to amend your tax return to pick that up. You file what's called a Form 3115. Your CPA can help you fill that out, or who's ever doing the work usually has a service for that too. But you can pick all that depreciation up on your current year return without amending the return, which is great.
And I think that's the process of what Aprio and yourself are doing for me as a case study. Yeah. Mm-hmm. And just to let our listeners know, just to have full transparency, about this process, that myself and Mike and Aprio are going through right now. I filed a extension for my taxes and for all the businesses that I own, all LLCs that all kind of flow together to personal income. I was about to have a $60,000 tax bill come due. And by doing this method and by doing this model that it was suggested, it's basically able to wipe all of that tax liability away, other than I think about $700. So I can say I'm pretty pleased with this process, and it has gone extremely smoothly and extremely well to my. Let's talk about some of the pros and cons here, Mike, about this process.
Sure. So, again, the main pro is if you're starting a business and you buy a building or you lease a building and you're building it out and you need cash flow in the first few years, this helps with that. So, and even if you have all this depreciation and you can't use it, you can defer it down the line and take it on, subsequent tax returns until it's used up. So that's the big benefit of it, is the cash flow it provides you sooner rather than later. Some of the cons are, and we always tell people this, is if you're not going to buy and hold the property, if you plan on flipping it or selling it, usually within about 5 years, you're going to have recapture. So what that means is that all that depreciation you took, you have to give back to the government. That's just the way it is. They're not going to let you take something up front and then sell it and then get to keep that. So you'll have to recapture that, meaning you have to basically give it back in the year that you sold it on that tax return. The rules there's a lot of rules going on there, so I'm not going to get way down in the weeds on that, but that's just kind of a general overall rule that we always tell folks.
And there are potential strategies to overcome that, I believe, correct?
There are, yeah. I mean, you could, there's a difference between the rates. If you're in a very high tax rate versus the recapture rate, there's, you could roll the property into a 1031, which that can help too, but you got to be careful of other issues that come up with that. So yeah, there are some strategies to mitigate that, but just to always be aware that that's out there. So
yeah, I think the audience that we have is pretty savvy in real estate, and they definitely understand the term 1031. I think that is very helpful to bring that up. Can you talk about the difference between bonus depreciation and accelerated depreciation?
Sure. So when we say accelerated depreciation, that just means we're moving actual hard assets from 39-year or 27.5-year property to 5, 7, or 15. We're accelerating the time or the depreciation on those assets. Bonus depreciation is actually laws passed by Congress. And what bonus depreciation lets you do is, for instance, if we moved 5-year something from 39 years to 5 years, and there's bonus depreciation available, that means whatever bonus depreciation is available that year, that you can take that much of the 5, 7, or 15-year property in that year. So the TCA passed in 2017, the Tax Cuts and Jobs Act, and that made bonus depreciation from that time, from late 17 through the end of 22, was 100%. So that means all of your 5, 7, and 15-year property, whether it was new or acquired property, could be written off the first year, because the TCJA Act and all these congressional acts are generally 10 years. The backside of those is when bonus phases out. So in 2023, it's now down to 80%. 24, it goes to 60. And then each year it goes 20 down to 0. So in 2023, you can take your 5-year property and take 80% of it in the first year, and the remainder 20% gets spread over the 5 years. And bonus depreciation has been around since 2001. It's been 30%, 50%, 100%. There was a couple of years in there was no bonus depreciation. So it gets extended. It tends to get brought up when the economy's not doing so well. So during recessions is generally when it gets ramped back up, or when there's tax cuts. That's always a big thing on the table. So
is this an either or method, either or combined?
No, it's combined. So
bonus depreciation and accelerated depreciation go hand in hand. It's not an either or.
Right. And you can you can opt out of bonus depreciation. You can opt out of it by class life. So if you say, okay, first few years, I really don't need the deductions, but I know I'm going to need them 3 or 4 years down the road. So you could say, okay, I'm going to take bonus depreciation on my 15-year property, but not on my 5-year property. You can opt out by a class life. But keep in mind, once you opt out, you can't opt back in. So you can't say, okay, you know what, I need it this year, so I'm going to go back and take my bonus. You can't do that once you opt out.
So you got to set the strategy initially. Interesting.
Yep.
Okay. Kind of tying that in with something we talked about earlier, let's go into multifamily properties a little bit, because I know that's what a lot of our listeners enjoy investing in the most. Where do they fall as far as that depreciation timeline schedule? Is that a 39-year or is that a 27.5 year for a multifamily?
So multifamily housing, if it meets the rules of residential rental property, meaning that typically you have to rent it for more than 30 days at a time, then it's residential rental, it's 27.5 year. If you're buying, and this has been super popular in the last 5-6 years, to buy a house, turn it into an Airbnb, put it on the market, those are not 27.5 year property. Those are 39-year property. They're short-term rentals. So you need to keep that in mind, because I've seen it, countless times where we do look back studies and they're depreciating as 27.5 and it's really 39. And we have to tell them, I can't, as a provider, say, oh, we're going to take the good stuff. We're going to move all your 5 and 15-year, but we're going to leave your building in 27.5. We can't do that. We have to fix it all at once, or we wouldn't, we wouldn't be doing what we should be doing. Yeah. So, but in 27.5 year property, residential rentals, multifamily, those are great cost seg projects for the most part. There's a lot of things inside that are part of your business of renting homes, right? Or, the type of flooring again, and, there's TV and computer connections and millwork and, the outsides, and especially in these apartment buildings with the swimming pools and the grills and open areas and the fitness centers and the clubhouses, all that stuff is considered personal property and part of the business as opposed to the building. So yeah, those typically make great opportunities for cost seg. I want to segue just for a moment on those. There's also other credits out there if you build these properties. With the IRA that just passed, there's always been this credit called 45L, and it basically gave builders of multifamily housing a credit per unit. And this is not a deduction, it's an actual credit of $2,000. It's went up now from $2,500 to $5,000. So that's a really great credit for multifamily housing. And there's actually another deduction in commercial space called 179D, and it's based on energy. Both of these are based on energy efficiency. So I want to bring that up too. We can help you with that, and we're doing a lot of that. And there's a big uptick in that because of the new deductions that are going to be available starting in 23. So
yeah, great information. You are extremely knowledgeable when you start spouting off tax code by the phone number. So that's pretty impressive. Well, I know kind of segueing into what you were saying earlier, this method is extremely popular with multifamily properties, long-term rental, over 30-day multifamily rental properties. I know a lot of our listeners, again, are savvy enough to understand that this accelerated depreciation, whenever they get a K1 at the end of the year, it's able to wipe out a large portion, if not majority of the portion of that passive income that they're receiving. So that is a huge benefit and win by being able to do something like this. Then being able to have that cash flow is a big deal.
Let's just touch on something there. We talked about passive income. So you have to realize that if you're a real estate investor and you're not actively in the real estate community, that these deductions can only go against, they're called passive deductions, or passive can only go against passive income. If you're in the real estate industry, then you have active income versus active deductions. So you got to keep that in mind too, because some investors, they don't need the deductions. So, I mean, they're passive. They're never going to get to the level where they need those deductions. So I guess that would be a con too that we didn't talk about earlier.
Yeah.
But yeah, there is passive versus active.
Yeah, good. And I'll unpack that if you don't mind too. Mike, what Mike said was brilliant. You can't have more deductions than rental income that was earned. Right? You can't go below negative. If you are a real estate professional as designated on how you file your taxes to the IRS on an annual basis. And personally, I have been a real estate professional on my taxes for 22 years. So in that circumstance, whether you're a real estate broker out there or someone else, you do have that ability to have more write-offs than rental income that comes in. Did I explain that properly, Mike?
That's correct. Yeah, because those deductions can now go against most or all of your income instead of just the income from your passive real estate.
Right.
Correct.
Yeah.
Yep.
For most of our listeners, the ability just to have a 1-to-1 ratio potential is probably the focus.
Yeah.
Yeah. All right. Two last questions for you, Mike, if you don't mind, as we kind of conclude our talk today. The question that I love to conclude with is, hey, what are some highs? What are some lows? And what have you learned, over your career and your journey in this?
Well, I mean, I like to look at real estate and buildings, and there's just so many stories you hear about buildings or, the architecture when you get in there, or, I've done some kind of cool stuff, like television production places and stuff, kind of see a lot of behind the scenes or manufacturing, how stuff's made. If you ever watched that show, like I've been in those plants where you go, oh, that's pretty cool how they do that. So you learn a lot of just about other stuff just by having to go do your job, which is really cool. So, the lows, accounting is, the accounting profession for the most part is recession proof. There's always accounting, right? You always got to do taxes, and there's always audits and financial statements. But the real estate market does go through highs and lows. So, but for cost seg, generally, if somebody's selling real estate, somebody else is buying real estate, right? There's always that buyer seller going on. So we tend to be kind of immune, but I've been in the industry and I've been at shops where we had to lay people off. So there are lows too, but it doesn't seem to affect us as much as maybe some other industries.
Definitely. Well, Mike, how can our audience connect with you and hear more about what you're up to if they want to get together?
Yeah. So if you want to, learn a little bit more about me, go out to aprio.com. And there's an about section and the people, and I'm right there. And there's, if you click on me, a big sheet will blow up all about me and what I do and about my family. And, it's a great piece that everybody has, in the leadership section of our firm. Or, just reach out to me at Mike Armstrong at aprio.com, and I'll be happy to, set something up with you, and we can talk about this in more detail.
Well, Mike, I can't thank you enough. Thank you for coming on. Thank you for educating our audience and our listeners more about what this process does, the benefits to them. And personally, I want to thank you for everything that you've done for myself and my businesses personally to help us out and get ahead.
Yeah. Well, thanks for having me this morning. I appreciate the time.
Thank you for hanging out with us today and for listening to the Freedom Point podcast powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.